the thing that scares me the most is the potential for this sell-off to become self-feeding and self-sustaining, especially with the Fed, in my mind, kind of clueless on the outlook. I mean, Powell gave a real poor press conference, and I'm worried the quantitative tightening could push equity prices lower and then cause a negative self-reinforcing feedback loop.
So it doesn't sound like you're too optimistic. John, do you agree? You think this is the Fed's fault?
Well, actually, I think it's probably more the result of open mouth operations over the weekend. It's the idea of warning people, or of telling people that the world is not going to end, and I've just talked to all the banks. That's the stupidest thing I've ever heard a cabinet member do, and I've been doing this a long time. Economy's basically okay, a little soft. Monetary policy is doing what it's supposed to do, maybe a little aggressively. But basically, this is the net worth economy still driving the ship. You know, one of the Fed's weaknesses is it always looks at the economy in terms of the GDP tables. The real issue is what's happening in the asset markets. And the asset markets aren't liking what they're seeing during this last several months.
Joe, Richmond Fed, obviously shipments take you back to the 09 low. Empire was a 19-month low, and we're going to get consumer confidence numbers in about 42 minutes. How important is it that those hold up?
It's important, Carl, but my fear is that December, as of yesterday, was the worst on record, or before yesterday, and you're going to see sentiment weaken further. So, I mean, God forbid the numbers turn out to be weaker now. Only imagine what they're going to look like next month after they'll fully reflect the equity volatility. So, I mean, John is right. We are an asset economy, but this behavior of markets really began when Powell gave a very hawkish speech in October. And I thought he did a good job at the end of November kind of walking it back. Then it was almost like he forgot everything in December. And I just think the Fed, this balance sheet unwind, which will total $600 billion next year, to me is a phenomenal amount of liquidity coming out of the market. And if markets go lower, sentiment will go with it, Carl, and that will lead to less production, less order flow, and ultimately, and sadly, less hiring.
John, but how's the market supposed to price in what we already know is a slowing global picture and a vast deceleration in U.S. corporate earnings? I mean, we're 15% off the all-time highs. Do we have to look for huge errors in monetary policy to explain something like that, or is that just kind of the ebb and flow of the markets responding to a slightly dimmer picture?
Well, remember, the deceleration in earnings growth is really because last year we had a huge bump in earnings growth caused by a one-time big tax policy change. And so 10% of last year's earnings growth was actually driven directly by the tax policy. So the earnings aren't all that bad. Revenues are still growing pretty strongly if you look at the S&P revenues. What you worry about in this kind of economy is that the asset prices changing themselves cross tripwires. And by tripwires, I mean things like basically margin calls. But in the corporate level, a margin call is what happens if you have collateralized assets to take on debt. That's an issue here. It's a bigger issue in China. So I'd be watching, bankruptcy and credit market issues. Credit markets have tightened very, very sharply in recent weeks. And it's not just the bond market or the junk, it's also the leveraged credit for the small business sector.
John makes a great point. And that's the thing is that, we're looking a lot of this equity move in some sense in isolation, or at least that's what it feels like to me. But global equity markets have been horrible. China's, by every economic metric, is slowing quite dramatically. We've had weak data, negative GDP data in Europe and Japan. And this makes it a global story. So that, to me, is really troubling. And, the one thing we're going to need the Fed is to basically back away from the hikes, either an intermeeting cut or an extraordinarily dovish statement at the January meeting.
Intermeeting cut? You don't think
Possibly,
that would shake some confidence?
No. Well, but look what's happened already. We already don't have. The credit markets are totally seizing up, to John's point, and it's global. So they could look. They probably won't, Carl. They'll probably go at some later point, and this will trip us into a recession, a classic monetary policy mistake.
I wanted to ask you, John, what the calculus is right now on trade. because, as Joe said, industrial profits in China down, first time in 3 years. We got word of these talks in mid-January, but then on the other hand, we got reports of this executive order being ready to ban Huawei and ZTE. It's like every step forward is met with a step back.
Yeah, absolutely. I think this hand-to-hand combat between the U.S. and China is really not going to end. We'll see some good days and some good weeks when they announce some progress. But basically, these two societies are getting in each other's face right now. And the tip of the spear is the Huawei ZTE story, because the rollout of 5G telecom technology across the emerging market world is what China is doing in order to advance its technology for its next 50 years, not its next 50 days. So I think this story is going to go on for a very long time. But as Joe said, you've got do we or don't we raise the rates, but you also have do we or don't we sell a ton of bonds from the Fed's portfolio. This will be the first year that the central banks of the world altogether have been huge net sellers. And when you sell something, its price goes down. Its price goes down or liquidity goes down, one or the other. And that's not a very good sign for 2019 monetary policy or asset prices. So right now, I'd only buy the ones you love, in little bits.
So Joe, just to clear up, there's two strong narratives going around Wall Street right now, and I think we're hearing them both, and they don't necessarily make sense together, and we hear them both actually from the administration, but also economists like yourself. One is, there's a major disconnect between the economy and the markets. The economy's fundamental data actually looks quite sound. Consumer spending, retail sales over the holiday. It doesn't make sense to see a market pull back 20%. The other thing we're hearing is that the Fed is making a mistake, hiking too much, being too hawkish, talking about hikes next year, which should happen if the economy looks solid. So can you square those two things? Who's wrong, who's right, and what's an investor to make of all that noise?
The markets are right, the Fed is wrong, which is typically the case. Look, if you look at the originally reported data, Sarah, back in 2007, we had 2 quarters in a row where GDP, Q2 and Q3 averaged nearly 4%. So you're right, the economy is strong, but the economy is where we are or where we've been. It's not where we're going. And sentiment indicators, which are softer, tend to be the most forward-looking. They respond to liquidity, they respond to risk-taking. And my fear is the Fed just doesn't have any idea what it's doing, and letting this balance sheet run off at the rate it's running off at, and raising rates when the rest of the world isn't. And you get a situation, as John was saying, where you have one central bank moving, the rest of the world isn't, and I've argued all year that creates massive dislocations. And unless the Fed relents quickly and professionally, this thing is going to remain pretty bad.